Welcome to Markets Now. I'm Michelle Rook with Dave Chatterton of Strategic Farm Marketing. Mostly lower prices in grain and livestock futures. A few exceptions in the wheat market. But Dave, let's talk about this risk off that we had in kind of the entire ag complex today. Where did that come from?
Yeah, Michelle, I think it's just that the overall sentiment of the market feels very heavy and a little bit bearish here at the moment. We're having trouble uncovering a lot of bullish news. I think that starts with the wheat complex, as you mentioned, able to finish a little bit to the upside today, but not before making new contract lows in those lead month contracts. And in doing so, I think trade very disappointed with that action as it relates to Russia cutting their quotas here for the second half of the Feb-June type period of the marketing year. We've had some excessive rainfall in Eastern Australia that's hurting quality, and we're getting no price reaction from that. So the old saying, a market that doesn't react bullishly to bullish news isn't bullish. It's kind of playing out here. And I think that sentiment bled over into the corn and the soybean complex as well here today. And soybeans also, not on the contract lows, but certainly within striking distance here, 4 to 7 cents away from those lows that we had a few weeks ago and back earlier in the fall.
So, Dave, we're getting into the end of the year. We're getting into lighter holiday trade. We don't have a lot of big bullish news to help any of the grain markets. So do you feel like there's more downside risk to the grain trade?
Well, I think certainly there are a number of producers who are getting more anxious by the day that are sitting on, stored or unpriced grain, and we're not getting much of a recovery here, typically in the seasonal fashion. We talked a little bit about that earlier, but, if we don't get much of a reaction by the middle of December, it's up to, guidance from the South American crop prospects to kind of get us there. And right now, those crop prospects seem to be improving or getting bigger. So I'm not necessarily overly bearish from current prices. I'm just lacking the reason that we're going to find a new buyer to come into this marketplace. Corn, funds do sit a little bit on the long side here, around 94,000 contracts as we started the day. That's a decent sized position, but it's not significant enough to really make the sway. And there's not a compelling reason, I don't think, for them to come in as fresh buyers at this particular point. Most of the analysts, I think, that we look at and the data that we have indicates that Mexico has been a very aggressive buyer, but has front loaded their corn purchases in a way to try and get around some political tariff potential and issues there. That's a whole separate issue. But in doing so, I think we're looking for a slowdown there. We're certainly looking for a slowdown in the bean export side of the complex with what's going on in South America and where their offers are. And we just haven't been able to get a foothold. So domestic crush margins coming down a little bit, ethanol probably slowing down a little bit. It's just a period here, as you mentioned, going into the end of the year where we need a little bit of help to get these markets going, and we're not finding it here at the moment.
The soybean market went back and tried to test the contract lows a couple of times. And with what you said about this big South American crop, do we take those areas out here eventually, you think?
I think there's certainly a risk that we do, Michelle. The seasonals in the marketplace right now are not necessarily overly negative. They don't indicate that soybeans should be working, sharply lower. I think if you look at the corn bean spread or the relationship or the ratio, we're about as wide in that, about as narrow in the premium for soybeans as we have been in any number of months going back several years here. And in doing so, it doesn't make another compelling argument that beans should be going, sharply lower. But I think over time here, with our expectations here that our market share will be quickly declining in the export side of the business, with a lack of guidance on the 45Z for the domestic biofuel side and crush margins, at least on the board, coming in rather sharply here over the last 2 to 3 weeks. We have to look at the market being a little bit weak here. Funds are still short a few beans, not a big position, and it can certainly add to that if the technical sign is there, and that sign would be taking out those lows. We're in position to test them here again this week, and hopefully they hold, but I'm not confident that they do. If they don't, I'm not looking for a big leg down, but I think we could stay soft here through the end of the year.
Yeah. And as you pointed out, we've thrown some good demand news at the corn market. We've thrown it at the bean market, but yet we failed to go up. That's always kind of a technical indicator that this market is in trouble, isn't it?
I think it is, and I think it goes along with the fundamentals here of everybody is looking at this South American crop, and some of the estimates that have come out have been pretty high popping. There, weather isn't perfect, but it's very good. The expectations are for a record crop. We'll have to wait on the soybean side of the complex. We'll have to wait a little bit longer on the corn until we get into the safrinha period to make a better prediction there. But global supplies are going up. And with that, China has not been active in our market in the feed grains, but China has been, Brazil has been the choice of China for both the soy and the feed grain complex when that supply is available. It certainly looks like we're going that way. And, it's going to be a battle. We're in a situation where global stocks are growing, and we're not looking for any kind of a V bottom here or anything like that. We need some fresh news here, and we need to kind of maintain the demand in the market share that we have. And it's questionable whether we're going to be able to do that at least into the first half of 2025.
Yeah. And this demand that we have seen, you believe that the market is sensing that that's all front loaded. So my question to you is this market fearful, or how fearful is it of tariffs, of a possible trade war?
Yeah, it's a really tough question to answer. And, geopolitics are always almost, possible to trade. But what I can tell you, Michelle, is I think part of that sentiment that we talked about earlier and kind of the heaviness in that sentiment comes from the uncertainty around some of these outcomes. And if you spin, what may or may not happen and what the administration may or may not do with China, with Mexico, with Canada, with the BRIC countries, certainly there's a lot of moving pieces there. We're going to get a lot of conflicting and headlines and different things that happen. But at the end of the day, there can be a positive outcome to those, but we don't know that at this particular point. And, we could see China go back to a system of buying against the phase one agreement, similar to what they did back in 2020. It could go completely the other way, but the uncertainty right now keeps people very cautious. And like I said, I think if you look at the outside money and the spec money that tends to come into our market in a bullish environment, I don't think it wants to jump in ahead of that uncertainty here at this particular point.
So Dave, why doesn't that uncertainty spill over into the equity sector?
Yeah, I think the equity sector much more insulated from the global piece. It's about the U.S. economy and how the performance has been, what employment is doing here, the Fed, and the actions, et cetera. If you look at our equity market versus what's happening in Europe, what's happening in Asia, what's happening in China, two separate stories there, where one being the U.S. economy performing well, the others are not. So, rightly or wrongly, that's how the trade is judging the outlook here at the moment. And, we've had crude oil kind of struggling here a little bit against the supply issue, even with the geopolitical issues that tends to be one of the macro market drivers that helps pull the grain market up. So right now, we're just not getting a lot of help on those drivers. The equity market is firm. Hopefully that's good for things like protein demand and overall performance of the economy, but it's not translating into support for grains here at the moment, Michelle.
Yeah. So the cattle market had a down day, and of course we've run up into chart resistance in the February live cattle right around 190, GM feeders right up in that 260 area. Is that just the problem? We're seeing profit taking because we ran up into resistance, or is this the rollover that we're starting to see in the box beef values?
Yeah, a good question, but a little too early to call the rollover right now. I think, kind of a quieter inside bar trading day from the charts here today in the cattle. And every time we've tried to pronounce the market dead and over, we tend to find it making new highs. Funds do sit at record length here in both the hog and the cattle complex, Michelle. And I think that's the biggest caution sign out here is that, the old saying, we need to feed the bull every day, and you need to keep making these new highs in order to keep that intact. So right now we've had, we've pushed to a new high. We've had a strong setback, a bounce back. Now we're consolidating just a little bit below those recent highs. As long as we're able to hold last week's low, let's say in that Feb around that 184.10 level, I think we're intact here on a technical basis. But any sign of weakness, we know that these guys in either one of these protein complexes, if they go for the door, they can go rather quickly. So it's a case where you need to look at the deferreds and know what your numbers are and what hedges or what levels may work for you down the road.
No doubt. And the same is true, like you say, in this hog market. There, we've seen cutout values get a little softer. The cash index is still under pressure. But what will be the signal for funds to start heading for the door all at the same time?
Yeah, I think it has to do with just, like I said, the ability to keep the market moving to new highs. Any stagnation here, you have to ask yourself, is this a rest stop along the trend, or is this the sign that we're getting ready to reverse? And I think there's, with record fund length in the marketplace here, and not one of the bigger or more liquid marketplaces that we find compared to the grains, compared to the oils, the metals, the softs, et cetera. We have to be a little bit cautious that their action can create a lot of volatility in a hurry here. And right now the market, from a cash side feels a little bit soft. It feels like the producer is current. Packer margins are pretty decent, and we're still in the situation where there just aren't the number of hogs around that the hog and pig report back in October indicated. And, we'll get a revision of that here in December, but that's combined with a little bit better demand to support this marketplace. But as that cash, or if that cash starts to weaken here seasonally, I think you have to be very careful about looking for additional upside in the marketplace.
All right. Thanks so much. Dave Chatterton with Strategic Farm Marketing. That's Markets Now.